Hey, Julien.
Nice to see you.
Let's have you settle down.
Thank you.
What was the motivation for setting up Jera Capital?
We had been working as a team, the three partners of Jera Capital at Nordea, and we realized that the secondaries market had become significantly more sophisticated in allowing an investor in that space to build a portfolio that would be obviously diversified, obviously with a risk-adjusted and entry price that would be lower because of the entry discount in the secondaries market. But with the emergence of the GP-led market, that also allowed us to add more concentration in high-quality companies. And the combination of those two angles made us realize that there was a market opportunity to create a secondary platform that would allow for shorter duration portfolios, like we see in the normal secondary market, but at the same time, longer-term value creation.
Let's turn now to Jera's value proposition.
So the underpinning principle under Jera Capital's creation is really twofold. So typical private equity fund is 10 years. During that period, investors in such a fund are locked and can only expect liquidity when the underlying fund is selling companies. The evergreen fund allows to provide investors with a significantly reduced liquidity in terms of horizon. It also allows investors to control that liquidity and the timing of their own investments. On the investment side, private equity funds have a 10-year life. The manager of those funds invests in those companies, and sometimes they want to hold those companies for longer. And with the emergence of the GP-led market, such a manager could sell a company from an older portfolio to a new vehicle to continue managing and developing that company. And that's why we look at Jera Capital as a novel solution for the investors and for the investments.
Can you just dig a little deeper into what the LP opportunity set looks like? Explain what the GP opportunity set looks like.
The secondary market overall is about $150 billion trading on an annual basis. The LP set is about 80 billion last year. The GP set is about 70 billion last year. The GP subset, the opportunity is for the managers who are managing strong companies to continue managing those companies, to continue harvesting the hard work they have put in place in the first years of their ownership of those companies, as opposed to being forced to sell those companies to a competitor or to a trade buyer or to IPO them and therefore pass over that value creation to a new owner. The median EBITDA in our portfolio is about 65-70 million euros. On the LP side, a number of the private equity investors, such as pension funds, had over-allocated to private equity because of the fast distributions that were taking place. Distributions drying up. Those investors find themselves with a portfolio that is too large in size and not reducing as fast as they would like. And the natural solution for this is to consider selling through the secondary market.